The last video we talked about due diligence. Now, once the due diligence is done and the buyer is fine to proceed, we then go to the transaction execution, and that will be SPA SSA review. So, what is an SPA or an SSA? An SPA is a share purchase agreement which is executed when the investor is buying the shares of them from an existing buyer, existing investor of the company. It is a secondary transaction document, whereas a SSA or share subscription agreement is for primary infusion into the company. Both of these agreements basically outline the rights that the investor would have in the company and indemnity or other protection that he may have in those transactions. So, what would you do in reviewing the SPA and SSA? So, from a tax perspective, the most important and the first thing that you will look at is the definitions of specifically tax or transaction tax and the tax authority or government authority. And there could be some other definition that might be of importance depending upon the overall nature of the transaction and the other parts of the SPA that we'll cover in the next ones. Then the second part that you will look for is representations, warranties, and indemnities. Representations and warranties are the statements that are made by all the three parties, that is buyer, seller, and the company, about the legal matters, title of the shares, and tax matters as well. And so our focus will be on the representation and warranties. The seller or the company would want to make more clear and more representation and warranties, whereas buyer would not want to have many clear cut warranties in that. And that is because whatever is disclosed in that document would mean that the buyer had known about it. So if anything negative happens because of that, the buyer would not have protection of that. But if it is not disclosed in those documents, then the buyer can say it he was unaware of it and can then ask the seller or the company to repay him or make him good for it. Whereas indemnity is a contractual obligation that is provided by a seller to the buyer for any specific matter. We'll go deeper into indemnity. So indemnity is generally, from a tax perspective, is for mostly from companies provided for an ongoing litigation which has a big amount. Special case of a primary infusion, the company or the seller would say that this is the litigation is going, and if there is any tax leakage because of it, we'll cover up to it this amount. Similarly for treaty benefit, and this is more common where the sellers have shares which are grandfathered. So for grandfather shares are basically shares which are acquired prior to 1st April 2017 from countries that have favorable tax treaty with India, which exempts capital gains tax in India. For example, Mauritius and Singapore. If the seller is taking the benefit of the treaty and asking the buyer not to withhold taxes on the gains arising on that, then the buyer would want an indemnity from the seller for that treaty benefit. And also similar to that would be the residence, an indemnity on the resident, that the resident or the selling shareholder is in fact a resident of Singapore or Mauritius for claiming that treaty benefit. And as we discussed in the prior slide, tax definition is one of the first things that you will look into an SPA. So as a buyer, you want a wide definition of tax, especially if you are asking for an indemnity for taxation related matters, because you want to cover majority of the tax, whereas a seller would want a narrower definition of those taxes. So this will be one of the most negotiated terms. And when you go into this rule, there are standard definitions that are available within every firm, within every team, which are generally what people would want to have in a SPA depending upon which side they are representing. Then another part of an SPA or SSA are the CP and CS. CP, CS are the condition precedents or consideration subsequent in a transaction. So these are the things that you have to provide prior to or after the transaction being undertaken. So these include a valuation report for the transaction to justify the valuation at which the transaction is being undertaken. This would be from a 50 CA 56 to 10 and FEMA perspective. The buyer can ask from the seller the information that he would need to file 15 CACB if applicable. Then the buyer can ask for 281 Section 281 certificate under Income Tax Act or Section 81 of the GST Act certificate or an opinion from an advisor. Then again a tax computation or an opinion. Tax computation if there is withholding, and opinion if the seller is taking a benefit of 3TAA, and the ownership documents. This is more from a legal point for justifying the ownership of the shares of the company. So some of the tips before your first ever SPA review is, before you jump into the SPA, that you have got to take some prior SPA that have already been reviewed in your team and understand what kind of comments they have provided on those. Then understand the issue that you had identified during due diligence, and based on that see where they should be covered, and particularly review the representation warranties, CPCS and indemnity part, because those are what you have to look for. Now before we leave the assignment for today, so if for which of the below three items would you ask for an indemnity if you are a buyer, ask an indemnity from a seller? Let me know in the comments below. Thanks for watching.